So where do you think is an attractive place to be right now?
Yeah, so we're really looking in sort of off-the-run niches. So one of them is in micro buyouts in the United States. We partner with a guy named Brent Beshore in Columbia, Missouri, who goes and buys small family-owned businesses, $2 to $4 million of EBITDA, pay very short, low multiples, 4 or 5 times earnings. You can't find that in the public markets.
Okay, where else?
One of the other places we love is harvesting volatility. So there's a terrific manager called, well, Harvest Volatility, as it turns out, and they do a wonderful job just capturing effectively the insurance premium on markets. And as markets start to bounce around more and more, that becomes a more attractive place to be.
And what would be another one?
One of my favorites recently is a crypto arbitrage fund. So if you can imagine, it's not owning Bitcoin, but there are all these different markets where Bitcoin's traded. And there's a firm called Hunting Hill Capital that specializes in arbitrage and is focusing just on that area of the market.
This all being the case, does that mean the average investor doesn't have access to the places that you really think are attractive investments right now?
I think that's true to some extent. I mean, alongside of that, what I do for the families I work with, we just buy low-cost passive exposure, sometimes semi-active exposure to public markets. So it's not a question of, can everyone access these things? These things are hard to access, and you need sort of the right relationships and specialized knowledge to do it. But to get exposure to broad brush areas of the markets, we can now do that incredibly cost effectively.
And it's funny you say that, because this idea that fees have to go as low as possible has migrated from a Jack Bogle thing that started the whole passive investing boom to something that's now maybe making more inroads in the hedge fund community. Do you think there's more room for fees to come down there, if that's going to be a way that these strategies are viable in the long run?
Yeah, and it's happening. It's happening, and it'll continue to happen. So one of the things that's tricky is that investors are used to saying hedge funds equals high fees. And it's still true. And some of the most talented players in active management are in the hedge fund space. But the investors have realized, boy, if the returns have come down because of that competition, we need to pay less in fees. That's happening, and it will continue to happen as the years go on.
I also wonder if pension funds, because of the nature of them, should be given lower fees than other investors. Is there a reason to privilege that class of investors?
One of the things that happens is just by size, like in any business, you get quantity discounts. I had Chris Ailman from CalSTRS on my podcast earlier this week, and he said, look, they can do things that smaller players can't. And you are seeing more and more of that, where the big pensions, if they want to participate in the alternatives, which is a big if, are doing it for lower costs.
One last thing, because we know about your famous bet with Warren Buffett about passive versus active management. There is now a firm who's saying that they think that crypto will outperform the S&P over the next 10 years. Which side of that bet would you be on?
I wouldn't take either side of that bet. I think it's...
Stay away from those bets.
I thought my bet was apples and oranges. This is like apples and pears and watermelons. I have no idea which one should outperform.
Well, we'll let you know anyway. We'll see what happens over the next 10 years. Ted, thank you very much for joining me. Always good to get your ideas.